Hi, and welcome to From the Research Chair, episode 15. I'm Jason Voss, and that is
Michael Falk.
today's
Happy Thursday, all.
Happy Thursday for those joining us live, and happy whatever day for those on the web. By the way, we're now over 110 subscribers on the YouTube channel. And Michael, I looked at the
Wait, so
stats.
we're not restricting the YouTube watchers to only watch our videos on Thursdays, Jason?
We're not. So, but I think that I looked, 2/3 of those subscribers are folks you and I don't know, which I think is quite interesting. So the word is slowly getting out. The intuition one from 2 weeks ago blew up. I think we have, yes, along with the flash. The intuition one is doing quite well. Not since our very first podcast have we had as much activity in there. Anyway, I digress. Today's subject is one of the great unloved, underappreciated things that Michael and I believe is value add for investment managers, and that is, Michael?
Scenario planning, scenario analysis. You can use any second word you prefer. Just don't call it forecasting.
Say more about that. Why can't we call it forecasting?
Well, because it's not appropriate. And if you think that I've made a misstatement, if you're listening, stick around because you're going to learn. It is not the same thing.
Definitely not the same thing. And on that point, we're going to offer up a definition here shortly of what scenario planning is. When I was at CFA Institute, I thought if anybody could grok scenario planning, it would be, the minds that tend to be a little bit more academic at CFA Institute. And people would repeat back to me what they heard, and they would navigate towards forecasting. So that's fiction one. It's not forecasting. Forecasting tends to be taking a business as usual situation. Notice I avoided the word scenario on purpose, and projecting, say, in a valuation model, a outperformed scenario, an underperformed scenario, and the sort of expected scenario. That is definitively not scenario planning, because that simply is the same narrative story, same set of expectations, same set of expected outcomes, but you happen to have you're allowing for, I misestimated something either up or down. That's not a scenario planning exercise. That is a forecasting exercise. Michael, did I miss anything?
Yeah, and the industry, if Jason didn't speak in a term that you're familiar with, most shops refer to that as a bull and a bear estimate. So how is that a scenario? It's just a new estimate. We're not talking about forecasting.
So how is it different? Michael, tell us why or how in your mind scenario planning is different than forecasting.
Well, let's imagine for a moment. Let's share a little love for value investors. Not that value is a real thing, but let's just share a little love for value investors. Value investors, well, here's a scenario. We have inflation. We have deflation. We have noflation, which means rates don't move, really. What are the different things that can happen to the business given an interest rate regime that is fundamentally different? Jason, would that qualify, or is that falling short?
No, I think that's pretty good. I'll amplify that by filling in a couple of blanks. One, scenario planning is imagining multiple narratives that are possible about the future, just as if we were writing a screenplay. We were talking before we hit the record button on today's podcast with Alam about superhero fiction. So what are the givens in Flash's life, for example? He's very fast. He's a scientist. We know who his arch villains are. Those are predetermined elements. But where we take the narratives of possible Flash futures are fairly unlimited. And yet we engage in this exercise all the time as investors because we imagine different possible futures for our portfolio, or we imagine different election outcomes or different economic scenarios, et cetera, all of which have radically different narratives that are not grounded in just one. And so scenario planning just says, let's bring process and structure to that process of storytelling, and then look at the insights we gain from that process And how does that allow us to be more nimble a priori or ex ante? How can we respond to possible futures in a more nimble way? Michael, you're nodding, you're smiling. Say more.
Well, what you just said in a simpler scientific terminology, forecasting is risk, scenario planning is uncertainty management.
Totally. You nailed it. You nailed it. That's exactly what it is. And in fact, I'm going to read in a quote here from a couple of the leading lights. And if you're not familiar with the space, Pierre Wack is credited with sort of advancing scenario planning out of the US military and making a thing for businesses. And the other leading light is Peter Schwartz. And both of whom I love these guys, especially like Peter Schwartz, but that's because I tend to be a little bit more qualitative than quantitative, and Schwartz is a little bit more qualitative than Wack. Anyway, this is a quote from Pierre Wack. Michael, forgive me for reading this. Scenarios deal with two worlds, the world of facts and the world of perceptions. They explore for facts, but they aim at perceptions inside the heads of decision makers. Their purpose is to gather and transform. Key word in how scenario planning is very helpful. Transform information of strategic significance into fresh perceptions. Next, from Peter Schwartz, scenarios are a tool for helping us to take a long view in a world of great uncertainty. Ding, ding, ding. There's your word, Michael. Scenarios are stories about the way the world might turn out tomorrow. Stories that can help us recognize and adapt to changing aspects of our present environment. I think it's quite interesting.
Yeah, and when we work with investors, right, they're trying to estimate a margin of safety. We covered that in prior podcasts. But how correct or incorrect might they be in their estimates? And when they win with the investment or when they lose with the investment, Jason, what we've learned, and we've mentioned before, is they don't question whether their thesis was right or wrong. No. So they actually don't know if they made a good or bad decision unless they measure the actual thesis correctness. And scenario planning makes, to me, is a little bit akin to this. You had a thesis, the number of potential things that could have happened. Oh my. It may not be an estimation error. You just might be wrong.
Oh, ouch. So let's put a little meat on the bones here, beyond what these pithy quotes and are trying to stress to you that this is important. I think there are two broad applications within investment management. One is managing the firm itself, right? And we've talked about firm strategy in a previous podcast. Mm-hmm. Scenario planning, I've only ever been engaged on scenario planning as a gig, as a consultant once. And it's different than strategy, because strategy basically says, hey, we take as given our business and the operating environment, and here's what we want to do. And it's basically the forecasting version of the future. Whereas scenario planning says, hey, we recognize there's a tremendous amount of uncertainty out there, active managers, and we want to thoughtfully plan for different possible futures. So that's one application. The other one is as an investor, which is how I used it during my career, is I would engage whenever I had the time, because it is a little bit laborious, admittedly, on the front end to do a scenario plan, but they are, if you do it well, they will be good estimates of possible futures for about 2 or 3 years. And they inform your decision-making and become a filter and help you identify investment ideas and themes earlier than others would. Michael, how have you used it?
Well, I start with a simple premise. Anytime I had an investment idea, my very first thing is, I might be wrong. Now, isn't that interesting? I started with, I might be wrong. So I begin looking for how I could be right and how I could be wrong, the scenarios. How might the world shift? How might the world change? What could happen? What might not happen? And I think I talked about once before on our podcast, a glorious error in judgment that I made once before. It was opportunity cost, a stock I did not buy that did very, very well over time. And I did the scenario planning, and I picked the most probable and I didn't act on it. I followed one of the other scenarios, and it wasn't even the one that I liked the best. So I didn't make oodles of money. I didn't lose anything. It was opportunity cost.
So, for the audience's benefit, I'm going to give three anecdotes of examples of where scenario planning has been powerful and where it has worked. The first one, which is the famous one, if you do a Wikipedia search, for example, on scenario planning, inevitably the following story is shared. And it goes back to the early 1970s. And Shell had been convinced by Pierre Wack to engage in scenario planning to plan its business strategy, as well as to help frame what assets to acquire. I'm talking about oil and natural gas assets, infrastructure in terms of distribution of energy assets to accumulate. And they did a number of scenarios about possible futures in the early 70s. And one of the scenarios that they came up with, which was a very radical narrative, was what if the price of oil soars? They didn't identify necessarily the causes accurately, quite famously, but lo and behold, what ended up happening was that OPEC, of course, colluded to raise oil prices, and it tanked many global economies because energy was such an important part as an input for various businesses. Shell responded within 3 to 6 months, depending on what part of the plan you're talking about. Competitors took 24 to 36 months to craft a response to that, because what they did is they dusted off their scenario plan because it had premeditated responses if this were to happen. And so they had already rehearsed possible responses to a huge spike in oil prices and a shutting down of supply. And they already knew how to respond because they had imagined that that was a possibility going forward. And by the way, it wasn't even the one that they thought was most probable, but nonetheless, they had rehearsed a response.
Yeah, and what we're talking about is multiple theses, right? And it's not necessarily, Jason, is this fair? Not necessarily your initial investment, but it's how you manage your investment over time, because you can switch from one thesis to another.
Yeah, absolutely. Yeah, and we'll get to the steps of how you do a scenario plan and how it's different, and you'll hear this. But two more anecdotes. These two are quicker, I think, than the OPEC story. A friend of mine is a guy named Jim Butcher, and he used to work at Morgan Stanley, and he was managing director of strategic planning. And they engaged in scenario planning as an exercise. One of the things that made Morgan different, and he loves to tell the story that of Y2K planning. Alam, you're fairly young, probably the youngest person on the call. Y2K was the belief that computer programmers had been lazy in accommodating 4-digit dates, and they'd only put 2 digits in there, and that when we rolled over at the millennium, that they would cause all kinds of computer problems, hence Y2K, year 2000. And Morgan Stanley did a bunch of scenarios of what if financial markets shut down and how will we respond? And lo and behold, Y2K came and went. And from a forecasting perspective, Y2K was a massive failure. And that's usually how history remembers Y2K. But all of that planning of what if financial markets close benefited Morgan Stanley when September 11th happened, because financial markets did close. And guess what? They dusted off their Y2K scenario plan. They knew how to respond. And within 2 or 3 days, they basically had their institutional response to Y2K. So because they looked at the outcomes, and this is one way that forecasting is different, it's outcome focused much more than input focused. Forecasting tends to be input focused. And because the outcome that they anticipated occurred, their rehearsed narrative allowed them to respond very quickly. So
It almost sounds like macros, right? But it's not a macro in terms of making a bet, which is how a lot of people think of macro. It's macro to be descriptive of an environment, and in the event that environment actually is occurring, it is in the present moment, not hypothetical. What would it imply for a range of investments?
completely. So it probably behooves us to sort of iterate through the steps. And I apologize, they're somewhat numerous. This is just for completeness. If you're really interested in this kind of work, Michael and I, of course, would love to work with your firm to do this. We have a lot of fun with this kind of work. And frequently our conversations, for those of you who have tuned in, tend to actually have kind of a scenario kind of quality to it, because Michael and I consider hypothetically various outcomes that might come to pass. So step one, and Michael—
Well, at least prepare them. If you're taking them down a long path, let them know if they're going to need to bring water. How many steps are there, Jason?
There are 11, but they're really only a couple of key ones. It's just for completeness that I've broken this out to make sure you get it. And it's in the podcast record. Point colleagues to this or hit us up or whatever, and we're happy to go over these. So step one, check your mindset. This sounds like, oh, that's obvious, but checking your mindset means, what biases about possible futures do I have in place, and having some familiarity with that? Michael, you're smiling.
Well, I'm smiling because I have, you can't see it on a shelf right now, I have a little stuffed animal that you can turn inside out. And if it's inside out, it's a bear. If it's the other way, it's a bull. I used to use that and put it on my desk to let people know what my macro mindset was at any given time. It was the bull or was the bear. You have a similar one.
I do. If I do the inside out, I've got the bear. I have two of these.
Mine's different, but it's the same. Yeah. That was I was staring at my mindset. It was on my desk. And then the question is always, is that mindset too fixed, Jason?
Yeah, it's exactly the question. Of course, we've talked about behavioral bias quite a bit in the podcast tangentially. So the first thing is check your mindset. You have to put down what you think is your status quo belief about how the future will unfold. And we all do it, right? As investors, it's only natural that we have our most likely scenario, and that's how we tend to plan. So you have to lay that bare. Step one. Step two is—
You said lay that bare. Was that intended to be a pun?
No, it's funny you should say that, though. I have the bull out right now because now I make my living as a consultant, but as an investor, my strategy did way better in bearish markets. So I was a perma bear almost as the puppet would be the bias. I had the bear side out most frequently. I neglected to mention checking your mindset. Michael, how often have we talked about the power of getting the group culture on an investment team right, or curiosity as antidotes to too much bias?
Frequently. Are they confirming a belief? Are they disconfirming a belief? Are they open to being wrong? Are they debating their agreement enough? I mean, all the different dimensions, if you will, around the culture. And the culture is, Jason and I, people can see us at times. Well, when we used to be in public, now we're all on Zoom. We may be having a wonderful little debate about some investment topic. And people might be seeing us debating, thinking we're arguing. Pause, ask Jason or me, are you having fun? And the answer would be like, oh, this is a riot. I love this. That's the difference, right? We can be actively disagreeing and enjoying it. Does the culture allow that? Or does active disagreement start to pull people and pull people apart, potentially risk the team-ing aspect of the team?
Great points. And I would say that for those of you who make investment decisions by team, and Michael, you and I work with quite a few, scenario planning has got to be, in my estimation, something that you do, because you finally have a vehicle for expressing all those differences of opinion, all that cognitive diversity in a very powerful way. And chances are you've already built your team in a way where that can be exalted, that capability. So the sum is greater than the parts than if, in fact, you're a solo act and you just make decisions, solo.
And Jason knows that I will kick off a lot of our work with teams last 6 months, maybe a little longer. This kickoff is going to stick around for a while, by the way. It has legs. To what extent do you think it is different this time? And we take a real-time poll a vote from the team. So it's anonymous. We don't know who said what, from strongly agree to strongly disagree. To what extent is it is different this time? Do you agree or do you disagree? We get a bunch of people who agree, but they haven't modified their investment processes. Well, if you agree it is different this time, then do you think maybe you need to change? That would be a scenario. It's different this time. I need to shift what I'm doing.
All right. So step two, yes. Just because in the interest of, time and get, not teasing too long here. Step two, identifying the key questions or decisions to consider. And here I'm going to introduce a case study from my own career. When circa 2000 in the dot-com era, as a guy who did care about valuation and who did care about business model and who did care about revenues, I was having a really hard time as an investor getting conviction about a lot of the dot-com companies. Nonetheless, I knew as a user of the internet, as a user of Amazon back in the day, way back in the day, that there was going to be success out of this. And I could see that it was reducing the cost of information because I shifted from reading annual reports paper-wise or sell-side research reports on occasion paper-wise to digital versions. Anyway, I digress. The question was, how can I participate in this growth market, tremendous growth market, without getting burned in some way? So that was the type of question that step two would seek to resolve. So with your team or solo, you could do scenario planning solo. It's better with a group. You identify the questions or decisions to consider. My question is, how do I participate in the dot-com situation in this once in a lifetime sort of reset of all technology? How do I participate? Michael, you're going to say something.
Well, my kickoff question for teams, really just to poke at them a little bit in a very gentle and polite way, is to what extent is it different this time? If you answer yes, now we have a dialogue we have to explore. If you answer no, we also have a dialogue that we have to explore. So you mean almost every single investment ratio that exists today is in the 100th percentile of costliness. Every single investment metric, and you look at that, and for historical people, we'd say it's flashing red. Get away. Maybe it's not flashing red. Maybe something else is going on. Can we have a dialogue?
Yeah, and scenario planning is a spotlight that you can shine into these dark places, and it's a framework for having these conversations so you can have insight. Which brings us to step three, which is creating evaluation criteria. How will you know this exercise is a success? For me, with the how do I invest in the dot-com and participate in the dot-com thing, the question for me was, what securities are most going to benefit from this that I can, sell to my board because they meet my, normal investment philosophy process and other criteria. Michael, do you have anything to add to that? And if not, I'll hit.
Well, I'll give you another example. People who are going back to inflation, deflation, or noflation, a lot of people are expecting interest rates to rise. I said, okay, so let's play that through. What would happen if interest rates rose 200 basis points on the 10-year US Treasury, as an example? Number one, could the US government pay its bills? Number two, what would happen to the general economy when the actual input costs, financing costs go up? What would it do to the real estate part of the economy, at least residential? And we have to work through all those questions.
What would it do to bank balance sheets, et cetera, et cetera?
Yeah, and the conclusion is, I don't think it can go up 200 basis points, because if it happened, it would be so utterly destructive that it would come right back down. It wouldn't remain there. So then we don't have to even think about it.
Great point. And that kind of thinking, that hypothetical thinking, is the hallmark of scenario planning, right? And so the scenario there that Michael considered is what would cause interest rates to go up by 200 basis points, and to begin to consider that. So that could be one of your scenarios as an investor. What if the following happens versus the status quo, which is, almost permanently, low interest rates.
And I have a pet peeve I'll just mention. People who are talking about the pandemic as a black swan. Oh, please stop reading so much Taleb. Actually, no, he's a good writer. He's a good writer. I have to give that to him. He's not a very good person, but he's a good writer. The point is a black swan. In 2015, Bill Gates was all over talking about the risk of pandemics. And then you see what's happening with global economies and food sources. Really? We had practice run with SARS. Really? This is not a
Ebola.
black swan.
Ebola.
Yeah, not a black swan. I really protest when people refer to it as such.
I totally agree.
I'm not saying it's not negative. Don't
And
get me
by the way,
wrong.
to ground that conversation for the audience, so here's how scenario planning might have worked well there. The question that was considered in step 2, IDing the question or decisions to consider, would be what happens to financial markets if global trade is shut down? Right? And think of our Y2K scenario. You didn't have to predict the cause, you just had to understand the outcome, right? So the outcome of Y2K ultimately would have been financial markets are shut down. How do we plan for that? So scenario planning is different from forecasting because, again, it's outcomes based. So could it be possible to consider what if global trade significantly declines? Yes. And by the way, there was a harbinger on the horizon, which was the Trump administration's trade war with China. So a thoughtful PM or investment team could have engaged in, what if this really escalates and it spreads like wildfire? The causal forces that result in that outcome may have been wrong, but your response, your rehearsed response to trade shutting down, COVID, would have been correct. And that would have allowed you to respond in your portfolio in a very, very nimble fashion. So step 4, we've now hit step 4, investigating your questions and decisions. So this is the one that looks more like a traditional sort of research analysis process. You've now got your questions in front of you. You haven't written your scenarios or authored your scenarios. You're just like, what's the latest, greatest thinking that's there? What's the status quo there? And in particular, what's fringy? Right? Who would have imagined that COVID would have happened and shut like global trade down? Not many. Michael and I actually had talked about a pandemic some time ago. So people who considered that would have been seen as fringy. So essentially in this step 4, you log and record, yes, the business as usual, but then you start to ask really crazy questions like that might seem very insane, and then start to dig for research for people who have considered these very issues. So the CDC here in the United States absolutely considered the ramifications if in fact there was a global pandemic. There are various organizations that considered, what if the trade war escalates? And you would begin gathering data and information to begin framing this.
So these essentially are a series of what if questions and no tinfoil hats. So when we talk about fringy, we're not talking about on the lunatic fringe. I want to be candid here, but just fringy, just regular fringy. No tinfoil hats. This is a big topic with me these days, Jason, because there's a lot of, let's say, beliefs that exist don't seem to have a factual basis. We're still talking about factual here.
Yeah, absolutely. And Michael, at the top, you said something insightful, which bears.
It was an accident. I deny.
Liar. No, it's not. I know you. You're deliberate. This scenario plan deals with uncertainty, right? So that's a good guidepost for. If it were known and certain, it'd be part of the business as usual scenario. So there's no real reason to go. So when we say fringy, we mean people who are actively considering hypothetical results that are in the uncertain space. So for example, what if the trade war tips into an actual hot war? And so you go from a trade cold war to a real hot war, say in the Straits of Malacca off of the coast of Singapore, because the US decides to naval blockade and prevent oil from getting to China. Ouch. Right? So you could imagine that as that's a fringy scenario. It seems unlikely, but a good scenario plan considers some of those that are, we'll call them 2 steps beyond what might seem normal. That's maybe a good way of thinking about it too. If it's 1 step beyond, it may already be factored into market prices of things. If it's 2 steps beyond, then it's in the uncertain realm.
Yeah, and let's give a little spotlight on something that's a really interesting topic if you want to dig in. Semiconductors. Where are most of them made? What is the risk of that locale? What happens if semiconductor manufacturing is offline for some period of time? You know, the whole world is running on these chips. So I'll give you a little light as a what if in that case. That's a real live grenade right now. Has been and will continue to be.
So, Michael, to your point, step 5 is after you first set up questions, then you gather data. Now that you have the data, you begin to refine the questions, because you may find that your initial assumptions were either too out there or not out there enough, right?
That
Things
might be wrong.
likely, or you may take out of the context certain things you thought were important that maybe are not important, because maybe there are fail safes in place that will deal with some of the things you thought might be catastrophic, or you may discover new information that considers your question to be altered just slightly. So step 5 is refine your questions. So before you endeavor to create these scenarios, you want to make sure that the question that you are asking is correct.
This is such a critical step. We have to emphasize this. What is it you want to know? Be really, really clear, because if you're not, you will waste an inordinate amount of time. So this is an important step.
Yeah, and ideally, if you're doing this with a team, you would, gather together, oftentimes facilitated, facilitated, and then you would be sent off to do the research. That could take up to like a month, 3-4 weeks, something like that. And then the questions are refined again in a group setting where you do some brainstorming. You're like, I think these are important considerations and questions, and this has to factor in. Step 6, this is the first, even while we've said each of these is key, this is where like rubber starts to hit the road. You're no longer hypothetically building a car, you're actually starting to drive and test drive the car. You identify the key factors and driving forces that affect your question or decision that you would like to make. And you start to notice and parse all of the data together into 2 categories. Predetermined elements. These are the things that are likely to occur no matter what happens. Demographics is a great example of a predetermined element. Sans a global pandemic that wipes out not what we've seen from COVID, but 40% of the population is the Black Plague. Sans something like that, demographics are kind of fixed.
They're probably the most stable long-term forecasting tool that has ever existed after the Black Plague.
Yeah, exactly. After the Black Plague or pre the next Black Plague or whatever it is, meteorite striking the planet, unknown. Another good example of a predetermined element would be huge government spending programs. Like China's Belt and Road Initiative is highly unlikely to be shifted in the next 10 years over any reasonable investment period of time. So government programs also frequently are put into the category of predetermined elements. The reason we make this distinction between predetermined elements and uncertain elements is the predetermined elements are ultimately going to show in each of the scenarios no matter what. And that's one of the criteria for evaluating whether they're predetermined. If you can imagine a scenario in which it's not, then it's not predetermined. It's an uncertain element with maybe a high probability. Mm-hmm. The next category is uncertain elements. These might be, for example, with regard to the Belt and Road Initiative, the uncertain element might be, will it change the Central Asian economies hugely or not so much? That might be an uncertain element that factors in. Will it unite Russia and China together in a Central Asian mass economy that competes with Western Europe or with the United States in a way that is unanticipated? Uncertain, unknown. So you begin to parse out this. The reason why is the uncertain elements are almost like the melody in music. These certain elements are like the rhythm. The rhythm is boom, 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 going to be present no matter what. The melody moves all over the place. As you construct your scenarios, it's where does the melody go in imagining these different scenarios? It's the part that is in flux, and they help you construct the scenarios. Michael, I've spoken for a while. Please say something.
Well, I just want to add, Belt and Road Initiative, one of the scenarios that I'm so curious about in that line of thinking is Africa. What is the stability of the influence of China in Africa for resources? And that has to be a node in this decision tree. When you start going down this, you have to think about that, because Africa is instrumental in a lot of ways in the Belt and Road Initiative. But what if they're no longer going to be?
Exactly. Great. I mean, a very good example of the type of question that you would ask. So now that you've divided up your research and your information into these predetermined elements and uncertain elements, the combination of them begins to suggest different scenarios that you can author. So step 7, again, a very meaty one, is you actually create the scenarios. And typical is 3 to 4. Less than 3, and you're basically talking about business as usual scenario, which is always one of the scenarios, and maybe one kind of radical one. 3 really helps to complete the picture. I think the sweet spot is 4, more than 4, and the likely decisions you would make should one of these scenarios unfold become a little bit watery. They become a little bit like she, if you will, right? They're just not very meaty decisions that you're going to be making. And the goal here is not to imagine every possible scenario. It's to imagine narratives that allow you to create front of mind filters of the world. So as news unfolds, you go, I wonder if this is what's happening right now. And this is my early warning system that is prepared.
Yeah,
So,
and before you think it's too far out on the fringe, to construct a narrative, you have to believe this is possible. So the narratives themselves pre-exist somewhere in the scenario. You just have to locate them, because the narratives, this is going to happen, unstoppable, this won't happen. All right, what are all the different things that go into those yes or no type of scenarios? The narratives exist. You have to discover them. So don't be put off. Don't think you have to be the creator. You have to discover them.
yeah, that's a really good way of describing that process. I'm going to read a quote right here. This one comes from Peter Schwartz, which I think is very helpful with regard to constructing the narratives. In a scenario process, and I've inserted the word investors here, in a scenario process, investors invent and then consider in depth several varied stories of equally plausible futures. The stories are carefully researched, full of relevant detail, oriented toward real life decisions, and designed, one hopes, to bring forward surprises and unexpected leaps of understanding. Together, the scenarios comprise a tool for ordering one's perceptions. The point is not to pick one preferred future and hope for it to come to pass, nor is the point to find the most probable future and adapt to it or bet the company on it. Rather, the point is to make strategic and/or investment decisions that will be sound for all plausible futures. And that's the key. After you construct these scenarios, which is step 7, you then look within the scenarios in step 8, and you think, what are the threads that actually unexpectedly show up in all of these, right? And can we begin to plan for different things in a way that we wouldn't? Or does it show up in 3 of the 4 scenarios? So it may seem like this is a prudent direction for us to go. I'll pause. Michael, say something, and then I'm going to follow up with an anecdote.
Well, I think about it as a kind of a density, right? Does the density of scenarios indicate some direction that is more likely? And again, it's not your most preferred. It's not the most likely scenario. What is the density across all the scenarios? And we're not talking about essentially mixing all the colors, the crayons in the crayon box, and we always get the same color brown as an output. It's really about the density. Is there a common thread, which means this is a reasonable investment to make, and then we have to keep an eye on it to see if there's directionality in what scenarios unfold. Should we take up the investment or take it down?
Yeah, so here's my anecdote. When I was at CFA Institute, we authored a document called Future State of the Investment Profession, which some of you in the audience might have read. And I had argued that we should take a scenario approach since we were considering possible futures. One of our scenarios was parallel worlds. And this was a recognition and acceptance of almost a permanent income disparity between the haves and have-nots that examined the different outcomes of that. And one of them that was somewhat unexpected, perhaps because most people imagine that ending badly, as opposed to the fact is that the difference between the wealthy and the poorer people in developed nations isn't really that different. Like the cell phone that Elon Musk is using today is probably a Samsung or an iPhone. Probably the quality of his electric lighting is probably fairly similar, et cetera. And so we saw these as parallel worlds, and what would the world look like if that happened? Another scenario, completely different, was strife. All of these factors that we examined, the predetermined elements as well as the uncertain elements, resulted not in a sort of a tension in a parallel world moving along, but absolute strife and a huge problem. One of the other scenarios was technological paradise, right? And here, all of the technology enabled society to get along in new and interesting ways. Cities were developed differently. The movement toward environment, dealing with the environment happened, et cetera, et cetera. And fourth was business as usual. So these are very different scenarios. Some are positive, some are not positive, but they all had very different names, narratives, and likely outcomes in how we would plan. For us, and this is relative to step 8, as we compared those scenarios, we saw one thing. The asset management business for active managers shrank in all of those scenarios. So that was one of our conclusions, is you would be dumb not to plan for that eventual future. So if you're an active manager, how are you going to preserve your margins was a question that we asked based on our scenario analysis. Michael, you've been nodding a lot. Sorry, been hogging the show.
Well, we share the conclusion that stress on the active management part of the industry. And now, while we agree on that, you and I are also fans of active management and want to help active managers persist and succeed. The challenge is success. The bigger you get, the harder it is. So now we're talking about the industry at scale. Can we have active managers at scale, or no, they have to be more boutique-y? And then a more scenario analysis. Which way does the industry go? And how does a boutique survive given higher costs in a regulatory environment? And what are the probable paths for boutiques to work towards surviving and thriving?
Yeah, at the firm level, those are exactly the questions to ask. And what the question in step 2, what's the question to consider if you did a scenario plan and you believed that, these look likely no matter the outcome, the existential question under consideration might be, do we scale up through acquisition, or do we become asset agglomerators and switch to passive ETF strategies where our value add as active people is identifying early on what is the hot ETF strategy? Or do we shrink, become boutique asset managers, maybe where our business model is not charging a management fee, but charging performance fees instead? Like, all of these things come into play and would factor into a scenario analysis. So step 9, rehearse the implications. So you've authored these scenarios. And by the way, a useful tip is to give them pithy names like parallel worlds, strife, things like that, so that they're easily remembered and front of mind. So now you rehearse the implications. If this happens, what would we do? What would be a thoughtful response to this? You then crystallize these. It's very important that they're crystallized so that if Y2K doesn't happen but 9/11 does, or if the OPEC spice spike due to a supply shock happens, you dust off the implications that you've already rehearsed and how you deal with it, the plan of action, so you can act now. So that's step 9. Step 10, you identify leading indicators that might be harbingers that this scenario is starting to take hold and take root, because then it tells you, this scenario looks very likely and we can act now. We don't have to wait for certainty, because we were so smart in our scenario planning that we identified things that nobody else seems to recognize. And this step right here turns out to be where most of the value add is. Michael, say something.
And you're not looking for tea leaves at that point. You're looking at kind of the fingers of the uncertainty. And as the fingers start to show themselves, you now have essentially permission to understand what is starting to change.
So in the Shell case, the classic case, their response to the oil embargo, even before the embargo happened, OPEC had been making noise in the press about how to bring more capital into the OPEC nations and how to act in concert to be able to make that happen. So there were rumblings before they took action. And Shell had that among their possible leading indicators is, greater public noise from OPEC that this may in fact occur. And they are also tracking economic indicators like what is the proportion of the economy that's reliant upon the internal combustion engine, for example, was something that
I remember. All right, this takes me back a year. A very famous University of Chicago professor who's no longer with us. He passed about a year or so ago. Big time lecturer. I approached him after a talk he gave, and I said, "What happens if the U.S. goes energy independent?" This was about 10, 15 years ago. And he goes, "Well, what do you mean?" I said, "Well, our relations in the Middle East, oil is priced in dollars. If we're energy independent, what happens?" He paused, and his response was, he didn't have a response. He didn't have a response. Then I saw him lecture again a few months later. He was quite popular. Almost an identical talk. He was stuck in business as usual, but he was a heck of a speaker and quite smart. But he couldn't imagine a scenario like I just raised. You destabilize peace in the Middle East when we're energy independent is one scenario that you have to factor in. Or no, peace changes on its own in the Middle East for different reasons. And we're energy independent and it doesn't matter.
Yeah, possible scenario there is without U.S. meddling in the Middle East politics, because we have to have the precious juice come to us, might change it so that there's peace that forms on its own. Might have been a scenario considered. All right, so we've done 10 of 11. The last step is you document, and you come up with evaluative metrics that allow you to track the success of the scenario. This exercise is done like every 2-ish years, probably 2 to 3 years. And if you do it well, my prediction is that as an investment organization, you'll be more nimble, you'll be more prepared, you'll have less shocks to your business model. If you do it at the investment level within your firm, my prediction is you'll begin to identify themes to invest in much sooner. So for me, to bring the narrative I shared at the top in terms of IDing the question, how did I invest in the .com era? I recognized through my scenario planning that electricity was needed for all of the things that companies were engaged in, and that everything was becoming more electric. So there was a breadth of electricity in devices. There's electric toothbrushes. There are talks of putting semiconductors into networked refrigerators, which is now a reality. Everything was becoming more electronic. So the broadening of electricity in all things and all devices was expanding tremendously, as well as deepening. Like, this is a deep story of electricity use. There's more computing power on this than what sent astronauts to the moon or sent some of the first probes out into outer space. And I recognize, oh my God, a cheap way to play this is to own electricity. And guess what? The multiples there were like 9 times, not 4.
Well, yeah. And now think about it. So the boom in internet stocks around the turn 99 to 2000, right around that period, and the complete disrespect for anything considered a value stock, utilities would have been on that list.
They were. And
the flip over 2000 to 2002 into a little bit longer was an immense differential favoring electricity.
So it is now the end of our prepared remarks. Are there any questions about this material?
Or comments?
Or comments, yeah, or blowbacks. Hey, we tried to do this, it sucked, it didn't work for us.
You can chat them in or unmute and show your camera and ask the question or share the comment directly. And, well, they're still here. So either they've fallen asleep, Jason, or they are still, their brains are on fire. They're still trying to think through, wow, okay, interesting, maybe usable, what ideas might I have?
So yeah, maybe we say this. We'll feed in here. If you're interested in this, there are a couple resources we can point you to. Michael and me would be first and preferred, of course, for us, somewhat selfishly. Secondly, I authored a guide with Sloan Ortel, one of my favorite people in the whole world, called the Investment Idea Generation Guide. Chapter 2 is all about scenario planning, and the quotes I've been reading in today to the podcast have come from that document. And that's another good place to start. Just chapter 2 is on scenario planning because it's such a rich source of investment ideas and differentiated from screens. Or 3, less preferred, at least for the sort of curious, read some of these books by Pierre Wack or Peter Schwartz. And there's a third one, and I'm forgetting his name, Martin, he's Danish. See if I can find it. But anyway, that would be the other place to start if this is of interest to you. There are very few things that I can endorse 10 out of 10 that are difference makers in investments. This would be one of them. And it comes from two things. One, it's very useful. I hope we've demonstrated that to you today. But very few people. The lack of attendance today on this podcast, despite having described it in our usual invite, this is my usual reaction. Michael, I know this is your usual reaction when we talk about scenario planning. It's not a well-traversed space in the business. And so there's alpha opportunity here for people who do it well.
There is. And, Jason, is a bit of a hallmark to one of our earliest podcasts. We referred to curiosity as a superpower. And let's just connect that dot. Scenario planning is doing something with your curiosity, leveraging your curiosity. And what happens is it keeps your eyes open. You don't form blinders. And you will be a better investor over time because of it.
Agreed. So seeing as that there are no questions, I think I want to, thank each of you who are in attendance. You're veterans, Joseph more recent than Eduardo and Sanchita and Alam, but thank you very much for your continued loyalty to what we do. Michael and I have so much huge fun doing this. And the fact that we choose to do them live. We could record these and just put them on YouTube because the YouTube audience is better, but we love the idea that there are people out there that we can appeal to and speak to. And I think it changes the tenor and tone of these. So thank you. And then, go ahead, Michael, were you going to say something?
Well, I was going to say, we're toying around with an idea. Can you give us feedback on this idea? Since we have done 15 episodes now, we think it's time for a little feedback. Format, topics, structure, dialogue, length. We may want to send a survey to you folks, a real simple survey. If you'd be so kind to complete it, we think we welcome your feedback. How about that?
Of course, and we would factor in the feedback into the podcast. And it could be anything. Expect that via email, since each of you is on our email distribution list. So the final thing is our next one is going to be in 2 weeks' time, as always. So it's the 18th of February, talking about something that I have been working on for over a decade called Deception and Truth Analysis. The acronym is DATA. It is a computer-driven text-based analysis of the level of deception in financial documents. I've been working with a technology company in the UK called Orbit Financial. As of this morning, it is live after a lot of work, and it's a very interesting technology because it is evaluating the 86.5% of financial data that isn't contained in numbers. In other words, language, which is mostly what we hear as financial professionals, and we don't tend to have structure and a way of quantifying insight in that realm, and this is a way to do it, and we'll be talking about
after 10 years of gestation, the baby has been born. Let's all give a congratulations to Jason on the new baby, Data.
I'm very thrilled. Thank you so much for joining us, and we'll send out a survey before too long. Thanks for joining us as always.
Bye all. Thank you for being here.